Assalamualaikum everyone. My name is Musab Iqbal and I'm the Vice President at REITs Department in JS Investments. Today, we'll be deep diving into Pakistan real estate pulse, where data meets development and insights drive investments. I'm thrilled to have you join us for this exclusive REIT webinar brought to you by JS Investments. Over the past year, we've analyzed a staggering 120 million square feet of gross covered area of different asset classes. Not just numbers, but they are stories of evolving demand, untapped potential, and shifting investor sentiment. This is more than a market update, it's a lens into the future of Pakistan's built environment. Today, we'll unpack trends that matter, spotlight opportunities that others may miss, and discuss how this data driven intelligence is shaping the way we structure REITs, underwrite developments, and unlock value for stakeholders. Let's get started because real estate is no longer just about location, it's about information. Pakistan real estate sector is expected to experience a differentiated recovery in 2025, with performance varying across asset classes and geographic tiers. Market dynamics will be influenced by macroeconomic stability, a potential downward interest rate cycle, and evolving policy frameworks. However, investment strategy will need to account for complex environments shaped by persistent affordability constraints, shifting consumer demands, and fragmented urban development patterns. Amid ongoing urbanization and population growth, the need for residential housing in major metropolitan centers remains strong. Over the half of Pakistan's urban population reside in just 21 cities, with Karachi and Lahore alone accounting for nearly a third. This concentration, driven by rural to urban migration, continues to strain the housing infrastructure of Tier 1 cities. However, actual residential absorption has slowed in 2024 as affordability challenges, elevated taxation, and macroeconomic uncertainty weigh on buyer sentiment. Despite lower transaction volumes, property prices have continued to escalate, largely due to higher construction costs and developer led pricing strategies. This divergence between price growth and demand underlines the widening gap in home ownership accessibility, particularly for middle income households. In the residential segment, affordability remains central challenge as per Pakistan Housing Building Finance Company 2024 report. The National Housing Affordability Index stands at 0.83, falling below the baseline of 1, signaling that housing remains out of reach for majority of households. In Sindh, affordability deteriorates further, with an average housing index of 0.57 and a house price to income ratio of 8.85, making ownership increasingly unviable. Even with a more accommodative interest rate environment, the burden of monthly mortgage payment, often around 40 to 50% of income, remains unsustainable. Rental affordability is also strained, with urban households in Sindh and Punjab allocating up to 90% of income towards rent, compared to 9% in rural regions. The commercial real estate segment is expected to register moderate growth in the coming year, supported by improved investor sentiment and favorable macroeconomic conditions. Traditionally, Tier 1 cities, including Islamabad, Lahore, and Karachi, are projected to remain active, particularly in retail, office, and institutional grade assets. The recent opening of Dolmen Mall Lahore with optimal occupancy rate is a strong indicator of continued confidence in high quality, well located commercial developments. However, shifts in demand, consumer behavior, and working models may influence the absorption patterns of the new supply. That said, an important shift is emerging in Tier 2 cities, where certain asset classes, particularly mid scale hotels, organized retail, logistics, are beginning to outperform due to chronic underinvestments, fragmented supply, and monopolistic dynamics. In many of these secondary markets, outdated and substandard inventory creates demand gaps that institutional investors and developers are increasingly looking to address. These opportunities, however, require deeper asset level due diligence, particularly in understanding liquidity, absorption cycle, business models, and regulatory environments, given the informal nature of many Tier 2 markets. Investor sentiments remain cautiously constructive. There is growing interest in income producing commercial assets, particularly through REITs, which offer regulated structures, transparency, and liquidity. In the residential space, however, investor activity remains subdued as stakeholders await greater policy clarity, especially around the anticipated construction revival package and budget 2025. Expectation had included potential tax reliefs and rebates for real estate. However, recent signals from the IMF suggest that any meaningful fiscal easing may be unlikely in the near term. Nonetheless, structure barriers such as the 30% minimum down payment requirement and low household savings rates continue to constrain demand expansion, particularly for middle income housing, until greater affordability or financial flexibility is introduced. Residential absorption is expected to remain under pressure. In conclusion, Pakistan's real estate market in 2025 will remain segmented in performance, with commercial assets in Tier 1 cities likely to benefit from improved investor appetite, while select Tier 2 cities gain traction in overlooked asset classes. The residential segment, however, will continue to grapple with affordability challenges, requiring targeted financing solutions, enhanced public private collaboration, and differentiated strategies tailored to regional market realities. We now jump on to investment landscape. Commercial real estate in prime location continues to attract strong interest from institutional investors as well as high net worth individuals and ultra high net worth individuals, driven by long-term growth potential. While zoning and building regulation have not kept pace with evolving urban needs, this regulatory lag is creating a strategic window for investors. With sustained population growth, it is increasingly inevitable that authorities will be compelled to update the building bylaws, particularly by increasing permissible inventory, that is called floor area ratio or density, on existing plots. This prospect enhances the appeal of acquiring open land in key locations, enabling investors to adopt a buy and hold strategy in anticipation of future legislative changes that could significantly uplift their asset value. The recent auctions conducted by the Capital Development Authority demonstrated robust demand for commercial real estate development in Islamabad, particularly in the G sector, where the institutional investor dominated transaction exceeding of PKR 10 billion rupees. Notable activity was also observed in I-8 markers and F7 markers, reinforcing sustained investor confidence in these key commercial hubs in the capital. The recent launch of Dolmen Mall Lahore, featuring the largest gross leasable area in Pakistan with more than optimal occupancy rate, has further reinforced investor confidence in commercial real estate while signaling strong business sentiment across the market. Following the revision of FBR valuation tables and 2024 budget announcement, transaction volumes across Tier 1 cities and Tier 2 cities have declined, well, excluding Islamabad, leading to a recalibration of real estate market. Although rental yields in commercial real estate have shown steady year-over-year growth, supporting stable or rising capitalization rates, higher tax rates have contributed to a growing disconnect between asking prices and investor valuations. This misalignment has dampened transaction volumes as buyers reassess return expectation under the current fiscal regime. As highlighted by Geltner et al. In Commercial Real Estate Analysis and Investment, a mismatch between market cap rates and investor expectation, particularly under shifting fiscal policies, can lead to pricing inefficiencies and transaction volume disruptions. This underscores the critical role of actively managing capitalization rates to align investor expectation with market realities and to maintain the valuation integrity of real estate assets. Now we'll get into understanding the real estate investment trust REIT industry landscape. REITs in Pakistan are at their infancy stage at the moment, but have consistently outperformed conventional real estate ownership models, underscoring the capability of RMCs and fund managers to deliver returns above their respective benchmarks. Looking ahead to 2025, we are anticipating over 50 billion rupees worth of real estate assets to be listed on Pakistan Stock Exchange, creating a structured avenue for real estate investor to access and benefit from high quality generational acquisition opportunities. Notably, REITs have demonstrated resilience during period of macroeconomic volatility, reinforcing their potential as an effective inflationary hedge in uncertain economic environments. As of starting of 2025, there are estimated 31 REIT management companies with total value of assets of more than 160 billion. Now we'll deep dive into real estate outlook on asset class basis. Starting off with offices. The Grade A office market in Tier 1 cities is positioned for stronger demand fundamentals in 2025. Multinational corporations and large-scale manufacturing enterprises seeking expansion will be key demand drivers. Moreover, a backlog of premium office space projects in prime location is expected to exert upward pressure on existing stock, driving rental growth. According to Jones Lang LaSalle, which is a JLL, a leading global real estate services firm, 53% of corporate occupiers anticipate expanding their office footprint over the next 5 years, signaling renewed confidence in commercial real estate. This was a global study. This shift allows Pakistan to capitalize on evolving global real estate dynamics and attract investment in office development. From the demand side, office demand in KLI region has remained stable, with average occupancy holding at an optimal level of around 80% throughout 2024. Notably, Grade A office spaces have outperformed due to delays in new construction, driven by elevated construction costs. As a result, occupancy for Grade A development has surpassed 90%, with average monthly lease rate exceeding PKR 300 rupees per square foot. In comparison, Grade B office spaces are leasing at significantly lower rates, averaging around 220 rupees per square foot. However, in Islamabad, the difference in lease rate between Grade A and Grade B properties is minimal. This indicates a rising tenant preference for Grade A buildings, and due to limited availability, demand is spilling over into Grade B developments. On the supply side, the current estimated gross covered area for office space in KLI region stands at approximately 12.5 million square feet, of which Grade A developments account for about 44% of the total existing supply. An additional 9.2 million square feet of office space is in the pipeline, although delivery timelines for these projects remain uncertain. We now discover about hotel as an asset class. The hospitality sector is positioned for a strong tailwind in 2025, driven by major international events and rising tourism. The recent ICC Men's Trophy, which was hosted in Pakistan and UAE, is a strong demand driver for hotel and lodging, particularly in Karachi, Lahore, and Islamabad. The average daily rate for hotels is projected to rise between approximately 10 to 15%, while occupancy levels are anticipated to return to pre-pandemic norms in Tier 1 cities. Meanwhile, Tier 2 markets will likely see even higher growth rates, benefiting from infrastructure development and increased domestic tourism. According to United Nations World Tourism Organization, Pakistan saw a 115% surge in foreign tourist arrivals in 2024, reinforcing its potential as an emerging tourism destination. With government-backed initiatives under the SIFC, which is Special Investment Facilitation Council, foreign investment inflows into hospitality are expected to accelerate. From the demand side, the hotel industry in Pakistan's major urban centers is showing signs of resilience, with a national average occupancy of approximately 70% in 2024. Islamabad leads the performance metric with 75% occupancy and ADR of approximately 47,000 rupees for five-star hotels, while Karachi follows closely with 72% occupancy and a modest ADR of approximately 23,000. Interestingly, Three-star hotels are outperforming in all cities, with an average occupancy of 75%, highlighting stable demand for affordable hospitality offerings. In Tier 2 city, this trend is even more pronounced. Despite limited infrastructure and brand presence, three-star hotels in these markets are achieving ADRs of up to 25,000 rupees with 75% occupancy. This performance is not necessarily driven by strong brand pull or service quality, but rather by the lack of alternative options, allowing even substandard facilities to command premium rates in monopolistic settings. From supply side of hospitality sector, the total room inventory estimated for 3 to 5 star hotels in Karachi, Lahore, and Islamabad stands at around 4,124 rooms, with Islamabad having the least supply at only 758 rooms, despite its superior performance in both occupancy and average daily room rate. This imbalance suggests that limited supply is inflating prices and occupancy levels rather than a purely demand driven market preference for higher end properties. Multiple hotel developments are underway in Islamabad, which is expected to alleviate the current supply pressure. The new stock is likely to bring much needed competition and pricing balance, especially in the 4 and 5 star segments. In Tier 2 cities, the dominance of underperforming hotels stems from lack of investments in branded quality properties. The success of three-star hotels in these areas presents a clear opportunity for investors and hotel operators to enter with standardized, well-managed product that command strong performance due to unmet market potential. Now we'll deep dive into retail as a real estate asset class. The retail real estate asset class is also positioned for steady expansion, particularly in Tier 1 cities, supported by a rising population, job growth, and infrastructure improvement. In this context, investors stand to benefit from rising lease rates and stable occupancy levels as malls continue to experience increased consumer traffic and growing footfall. From the demand side, retail in Pakistan's major metropolitan market continues to show strong occupancy trends with a national average of 89%, reflecting resilient demand across both Grade A and Grade B developments. The Grade A retail spaces are leading the segment with an average occupancy of approximately 94%, demonstrating consistent demand for high quality, well located retail developments. Karachi leads with approximately 96% occupancy, followed by Lahore and then Islamabad at 92%, underscoring nationwide confidence in premium retail assets. Interestingly, Grade B spaces are also performing steadily with approximately 86% occupancy as a national average, although with regional variations where Karachi has reached 91%, Lahore somewhere between 87%, and Islamabad trailing at around 81%, suggesting tenant hesitancy towards secondary retail assets in Islamabad. Lease rates further reflect this disparity, with Grade A lease rate being highest in Karachi at around 850 rupees per square foot per month, compared to Islamabad, which is around 700 rupees per square foot per month, and then Lahore, which is around 600 rupees per square foot per month. Grade B lease rates ranges between 350 to 440 rupees per square foot per month, again with Islamabad slightly ahead of Lahore, likely due to smaller sample base of Grade B supply in Islamabad. These dynamics suggest that retail tenants prefer quality spaces, especially in urban centers where customer footfall and brand visibilities are crucial. The comparatively high lease rates and occupancy in Grade A spaces affirm this. From the supply side, the estimated gross covered area of retail across the major three cities that are KLI is approximately 26 million square feet, of which 15 million square feet is currently operational and existing, and approximately 11 million square feet is in the upcoming pipeline. Islamabad is driving future retail expansion with approximately 7.5 million square feet of gross covered area, accounting for nearly 74% of the national upcoming stock in retail. This reflects a major shift in retail development trends toward the capital, potentially filling the demand gap for quality retail infrastructure. Lahore and Karachi have more balanced stock distribution. Lahore's estimated stock of approximately 8 million square feet already dominates the retail landscape, but upcoming supply is modest at 1.5 million square feet, suggesting the market may be reaching near saturation. In grade segmentation, grade A supply represents the bulk of the operational or existing inventory at 14 million square feet, which is about 92% of the existing supply. Grade B supply with only 3 million square feet approximately in existence and 1.5 million in upcoming, all of which is concentrated in Lahore. This highlight a growing opportunity in developing mid-tier community-focused retail developments in under-penetrated zones, particularly in areas beyond city cores where there is consumer demand but limited organized retail offerings. Now we'll get into the residential real estate as an asset class and deep dive into understanding the demand and supply dynamics. From the demand side, the vertical residential market in Pakistan has experienced a significant slowdown in take-up rates during 2024. This decline is largely attributed to increased taxation measures introduced in post 2022 which have weighed on investor sentiment and reduced end user affordability. The average take-up rate across urban centers is around 54 units per development. This is down notably from the more robust absorption observed in 2021 and 2022. Lahore stands out with relatively higher take-up rates, suggesting continued interest in vertical living, possibly due to localized demand and limited supply pressure. Islamabad follows the absorption, and at the end, it's Karachi. Karachi, despite being the largest vertical residential market, reflects a subdued take-up of a very low number of units, signaling oversupply and cautious market behavior. This softening demand is also evident in buyer preference for completed or near completion projects, with speculative off-plan interest considerably lower. From the supply side, the estimated total gross covered area for vertical development across KLI stands at approximately 83 million square feet, with Karachi accounting for a massive 86% share. Of this, nearly 60% is in the upcoming pipeline, but delivery timelines remain uncertain as developer delay launches or slow construction in response to reduced absorption and cash flow constraints. The existing stock is concentrated heavily in Karachi with far smaller volumes in Islamabad and Lahore. Average pricing shows Islamabad is leading at approximately 35,000 rupees per square foot, followed by Karachi and then Lahore. These price levels, especially in Islamabad, suggest niche demand in premium vertical developments, though affordability remains a concern and a key barrier to volume absorption across all three cities. Overall, the market currently reflects a supply heavy and demand light scenario, especially in Karachi, with a high risk of inventory overhang, unless taxation relief, financing support, or targeted buyer incentives are introduced to re-stimulate the housing market. In conclusion, while 2025 holds potential for economic recovery, enduring structural challenges continue to influence market dynamics. Key obstacles include elevated taxation, outdated building regulations, limited financial inclusion, inadequate adoption of ESG principles, and speculative real estate activities, all of which restrict affordability for middle income segments and make investors hesitant to enter a overheated market. In anticipation of the upcoming 2025 budget, stakeholders had hoped for tax relief measures to stimulate growth. However, recent negotiation with the IMF suggests that such relief is unlikely. The IMF has proposed a tax revenue target exceeding 15 trillion rupees for the next fiscal year, aiming to elevate the tax to GDP ratio. Further, the IMF has declined requests to reduce property taxes, maintaining stringent fiscal measures. On a positive note, regulatory adjustments are underway, indicating a proactive approach to market recalibration. The Capital Development Authority has increased the floor area ratio and extended commercial payment plans, promoting inclusivity beyond high income demographics. Conversely, the Sindh Building Control Authority has yet to implement similar measures, leaving Karachi and other key urban centers facing development bottlenecks amid ongoing urban migration trends. A government led task force on housing sector development established under the Prime Minister's office is expected to provide critical support to the real estate sector. This task force is evaluating the impact of recent taxation policies and working toward a more balanced tax framework for housing and construction. Effective implementation of these measures could unlock growth potential in the residential segment and support sustainable development. Additionally, the progress of the real estate investment trust industry is contingent upon the revival of Section 99A of Second Schedule Part 1 of the Income Tax Ordinance. Steps in right direction are essential to drive industry's upward trajectory. Thank you for your kind attention throughout my REIT webinar, and now we'll be moving towards our Q&A session. So now we move on to our first question, which says, what can REITs and developers do if tax relief doesn't come in budget 2025? Since property tax cuts are not very likely, REITs and developers may need to work a little smarter. They can focus on properties that can earn steady incomes like hotels, malls, and office spaces. And they can use REIT to sell completed assets and raise cash for new projects. Partner with landowners and investors to share cost and risk, and then attract investor by offering Sharia compliant or income focused real estate products. Basically, they should avoid relying only on property price increases and instead focus on steady rental income and smart partnerships. Now, there's an interesting question over here. How REITs can make housing more affordable? Well, there are various ways to look at it. From back of my head that I can think of right now is if somebody wants to invest to creating a REIT fund, giving to an RMC a mandate to do affordable housing, what RMC can do then is work with maybe government to develop housing on a cheaper land, or with public support, they can support projects linked to home loan programs. They can also create rental housing REITs that focus on long-term income. The key is shifting focus from just selling homes to creating affordable rental options as well. That is some part that can be looked at from the REITs perspective. Okay, there is another question. When will building rules in Karachi change? And how should investor plan for that? Well, I cannot really comment when that change is going to happen. It might take few years. But smart investors can buy land in good location now and wait for the rules to change. Look for land near main roads or corners as they're more likely to benefit from it. Be patient and plan for a 2-4 year wait to see real value increase. Okay. What should investor keep in mind before investing in tier 2 cities? So to answer that question, well, basically the tier 2 cities offer great potential, but also come with more risks. So before investments, one need to make sure to study the local demand carefully, check if people need, asset classes like hotels, malls, or warehouses. And also the other part is to understand the legal side, such as the land titles can be unclear in smaller cities. So one has to be very careful in their legal due diligence. Work with smart and experienced operators and developers of real estate, people who have already managed large scale development, hotel, retail. And then you may start small and then expand only if demand is proven. In short, it's important to do your homework and take step by step. Okay. Besides Section 99A, what else does the REIT industry need to grow? Well, to grow any industry in Pakistan, it's very important to have regulatory certainty. There has to be a clear tax rules and some support from the tax side as well. Also, encouraging banks, pension funds, and Islamic funds to invest in REIT will bring in more capital and help the market grow. Thank you, everyone, for taking time. It was quite an interactive session of Q&A, and I hope you all have enjoyed this session and have learned through our REIT webinar. We look forward on welcoming you again. Assalamu alaikum.